Hi there, welcome to Kneppy Invest. There are a myriad of companies on the ASX and other exchanges around the world, ranging from mega cap companies like Apple, which has a market cap about $2 trillion, to micro or nano cap companies that have market caps of about $1 million or even less. Now, if I was given a choice of what type of companies to invest in, I probably would sway towards small cap companies simply because of the potential of significant growth in the future. And that's definitely true on the ASX, maybe not as true on the NASDAQ, because I think Alphabet, Apple, Microsoft, Nvidia, all those companies have a long pathway to significant growth. But when you look at the ASX, we're talking about banks, and the growth profile of banks is almost non-existent. So if I did have a choice on the ASX to invest in small cap companies versus large cap companies, I'm going to choose small cap companies. But there are a plethora of small cap companies on the ASX, and the majority of small cap companies on the ASX are not profitable. So it is difficult to find those sort of companies that will make it in the long run because, again, the majority of small cap companies won't succeed. So in today's video, I'm going to share with you two profitable dividend paying small cap companies that you might want to buy in the future. Now, I've got a question mark there because both of these companies I don't own or have in my portfolio, and I wouldn't suggest these companies are buys. I think that's up to you. Now, the two companies I will be focusing or featuring in today's video, I do have a preference of one of these companies over the other, and I probably will make that pretty clear when I talk about both of these companies. Now, why do I prefer small cap companies over large cap companies? Now, I'm going to give you an example. And in fact, we're going to go back to 2013 to look at one company on the ASX that wasn't that successful at that point in time. And then we're going to look at the period between 2013 and 2023 and see or witness the growth potential in small cap companies. Now, I won't say what this company is, and you could have a little bit of a guess, or you could look at this video and the company is actually on the top left here, but hopefully you won't look at it because you'll see the massive change, and you will also be able to see the inflection point this company had in 2013. So in 2013, this company had revenue of $11 million and a market cap of $42 million. And you can just see by this chart, this company had been on the ASX for a while at this point in time, and this is a period between 2003 and 2013. In fact, during that 10-year period, the share price actually went down. So the market wasn't interested in this company at all. In fact, back in 2013, I was an investor back then, and I had never heard of this company. But in 2012, 2013, we started to see signs of this company hitting a very important inflection point. So let's say the updated numbers for this company in 2023. So in 2023, this company has revenue of $93 million and a market cap of $6.3 billion. Again, $6.3 billion. So it's gone from a market cap of $40 million to a market cap of $6.3 billion. So that's an increase, just doing rough numbers here, times by 10 and then times by another 15. So we're talking about a 150-fold increase in the market cap of this company over a 10-year period. You can just see the chart here. So if we go back to 2013, share price was hovering around about 40 cents, say between 20 and 40 cents. In fact, share price started to move into its uptrend in 2013. So share price has gone from 20, 40 cents all the way to a current share price of, what is it, $60. This is the sort of company you want to own in your portfolio for the long term. And for those who don't know, this company is Pro Medicus. So this is the sort of company I am looking for every day on the ASX. Maybe not every day, but on the ASX. Now, I am not suggesting the two companies I'm featuring in today's video will be a Pro Medicus of the future. I think there are totally different companies than Pro Medicus, but this is a possibility. So that's why I'm more interested in small cap companies over large cap companies, particularly those large cap companies on the ASX that have virtually zero growth in the future. First company we want to look at is Laserbond. This is a service engineering company that is trying to prolong or extend the life of machinery. When it comes to machinery for like mining companies and similar companies like that, expenditure on maintenance and buying new machinery is quite high. And companies that do have a lot of capital expenditure on machinery will always try to extend the life of that machinery as long as possible to decrease their costs. And that's where Laserbond comes in. Now, when it comes to understanding these companies, particularly deciding whether these companies are low quality or high quality, or even if they're making that transition from low quality to high quality, and that's a very important transition, I look at a few things. I look at revenue growth over certain periods of time. I look at a return on invested capital or return on equity. The best way to look at those two metrics is quality of earnings and also potential of shareholder returns in the future. Also look at valuation, EV to EBIT, P ratio, price operating cash flow, or EV to free cash flow, those sort of things. And then I compare those numbers to the total return over the past 10 years, 5 years, or whatever years the company has been listed on the ASX. So I want to compare that number to those other numbers as well. And then also have my own opinion on the company in terms of quality and also have some notes. So I do this for every single company on the ASX. Maybe not every single company, but a lot of companies on the ASX, I go through this process when I'm researching that company. On the bottom left there, I have total revenues over the past 10 years, also income and gross margins. So I always look at gross margins, operating margins, and preferably I like to see those margins increasing through time and at the very least not decreasing. So now on to Laserbond. So the very first thing I always look at when I'm researching companies is revenue growth. Is revenue growing through time, preferably above 10% per year? And for Laserbond, revenue growth of 8.1% last 10 years, 13.2% over the last 5 years. Also look at 3 years and trailing 12 months, but it's better just to look at those long-term revenue growth numbers. And this is revenue per share growth, not just plain revenue, but revenue per share growth. So the main thing here, over the last 5 years, revenue per share growth at 13.2%. In the last year, 15%. Now, this company may have been affected by COVID-19. We did see a bit of a slowdown in revenue per share growth during 2020 and 2021, but revenue has grown from $9 million in 2013 to $31 million in 2022. So the revenue for this company is definitely growing. So that's a big tick in my books. And we also have seen that revenue growth above 10%. So that's another tick in my book. Not only that, this company is increasing not only their gross margins, but also their profit. Maybe I should have said that the other way around. This company is increasing their profit and also increasing their gross margins. So that's very important. So gross margins have increased from about 46% to 54%, and profits increased from being negative $4 million to positive $3.6 million. And these are my comments when it comes to this company. Consistent revenue growth above 10% per year, return on invested capital median above 10%. So I looked at the past 10 years, and most years this company has return on invested capital and return on equity above 10. That's another big tick in my book. Increasing margins and okay valuation. So I'm not sure why I'm the shareholder in this company. I've also mentioned total returns, 21.9% per year over the past 10 years. So if you've been a shareholder of this company over the past 10 years, you're a happy shareholder. You'll be able to see that when we look at the chart. And in my quality section, I'd probably say this is a lower quality company, but it might be making that transition from a low quality company to a high quality company. And those are the sort of companies I want to own or have in my portfolio, because it's very exciting when a company makes that transition from low to high quality. So definitely I am interested in taking a position in this company right now, just based off this little bit of research. So Laserbond right now has a market cap of about $85 million, P ratio 22, which is not too high, not too low, particularly if it continues to grow at a pretty good rate over the next few years. Also, this is a dividend-paying company, and both companies are dividend-paying companies. So it has a dividend yield of 2%, which is not that high, not that low. So that's an added benefit. If this company continues to grow, more than likely the dividends will increase through time. And if you have a capital outlay right now, that dividend yield on that capital outlay will continue to increase. So go to 2%, 3%, 4%, 6%. Maybe in 10 years, your dividend on your initial capital could be 15, 20, even 30%. Now to the weekly chart. Now, I'm not going back 10 years. This is only to 2017. Because between about 2012 and 2017, share price of Laserbond was sideways, flat, at around about 12, 10 cents, something like that. And then we saw a little bit of excitement in this company in 2018. Share price was around about 15 cents. And the share price has been in an uptrend since then. And this is a long-term uptrend. Only twice, actually, we'll say 3 times. Only 3 times has the share price of this company fallen below the 150-week moving average. And the other 2 times it fell below that, or the first 2 times it fell below that moving average. It was only below that moving average for a very short period of time. We're talking about a few weeks, and then the share price continued on its uptrend. Now, you could say and argue the share price has been going sideways for the past 2 years because the share price reached its high of $1.07 back in the middle of 2021. And since then, the share price hasn't got above that particular high. And then in the last week, I have been paying attention to the share price. The share price has fallen back below that 150-week moving average. Now, another negative way to look at this is share price has also fallen below a support level. So there's a bullish case because the share price is now in a support zone just below that moving average. But there's also a bear case. The share price has fallen below a support level. So that comes back to whether you consider this company high quality or low quality, whether it's making that transition from low quality to high quality. Because if I think it can make that transition, I would be willing to hold this company for the long term, and the share price dip could be an opportunity to take a position in this company at better valuations. The second company I want to talk about is Veem. This company is a designer and manufacturer of marine propulsion and stabilization systems for luxury motor yachts, ferries, I think fast ferries, commercial workboats, and defense industry boats as well. So when we compare Laserbond to this company, you will notice a little bit of differences when it comes to revenue growth, return on invested capital, even the total return. So just based off those differences, it should be no shock. But I probably would consider Laserbond to be the better quality company out of these two. So Veem has only been a listed company since 2016, I believe October 2016. So it's been on the ASX for almost 7 years. So how is it done when it comes to revenue growth? So we can't go back 10 years. We can only go back 5 years. So over the past 5 years, Veem has grown the revenue per share at 6.7% per year. Last 3 years, 4.9%. Trailing 12 months, negative 5.8%. So we have seen revenue drop in the last year from $59 million to $54 million. And if you do look at the revenue history of this company, it has grown, but it has grown slowly from $41 million to $54 million. The other thing to notice when we look at the bottom left chart is that gross margins have also dropped. That is a red flag. So gross margins back in 2016 and 2017 were roughly around 70%. Now they're down to 56%. And profit has fallen from $5 million in 2016 to $1.2 million in 2022. However, you might suggest that maybe that $1.2 million is on the low side. And if you do argue that, that probably would support the reasoning why this company on a valuation endpoint does look a little bit expensive. EV to EBIT 22.4, which is a little bit higher than I would like for this type of company. However, again, I think $1.3 million of profit in the last year is probably understating the performance of the company. And the total return of Veem over the last 5 years is only 3.5% per year, but that's understandable when we look at the chart. The share price is almost at historic lows for this company. So with a return on invested capital of about 4.5, significantly lower than I would like. So I do prefer companies to have a return on invested capital, return on equity above 10. Not only is that return on invested capital right now at 4.5, historically, it's less than 10. I don't remember seeing 1 year where this company had a return on invested capital more than 10. So unlike Laserbond, which I thought or think it could be making that transition from a low quality company to a high quality company, and that transition could take 5 years, I don't think Veem is quite there yet, but it has the potential in the future to go down that path. So I definitely have Veem on my watch list. I will be paying attention to how they perform financially in the next few years. And my thoughts on this company: decreasing revenue growth in the past year. It could be just a one-off. And return on invested capital less than 10 every single year since 2017. So a few red flags when it comes to this company. Market cap of Veem is around about $62 million, which is a little bit lower than Laserbond. So you might say this company is cheaper. But the way I look at this is Laserbond is, in my opinion, the better quality company out of the two, has a better chance for continuing its revenue profit growth trajectory than Veem has, particularly because Veem has some red flags when it comes to revenue growth, has some red flags when it comes to return on invested capital and return on equity. So I think I would be willing to pay him a little bit more for Laserbond right now. But in saying that, P/E ratio for both companies is around 22. Now, the reason why I wouldn't be concerned about P/E ratio of 22 for Veem is because of their low profit in the past year. And it wouldn't be surprising to see Veem double their profit in the next financial year. And if Veem doubles their profit and share price stays where it is now, by definition, the P/E ratio must halve. And a P/E ratio of 11 doesn't seem that too stretched for this company. Dividend yield 1.4, so a little bit lower than Laserbond. So again, another reason why I probably would prefer Laserbond is their growth trajectory, nice return on invested capital, return on equity, and also a better dividend yield. Now onto the chart for Veem. And there was a bit of excitement about this company back in 2021. Share price went from about 40 cents or so to a high of $1.44. Can't remember why there was so much excitement, but then that excitement waned away fairly quickly. And we have this Matterhorn pattern up the side of the mountain and then down rapidly the other side of the mountain. Share price fell from $1.44 all the way back down to 40 cents. So around about 40 cents or just below 40 cents is a really strong support level for Veem. We have seen the share price hit that level 3 times in the past. There are people saying technical analysis doesn't work. This is more proof that technical analysis works. Every single time the share price gets to this support level, at about, I think it's about 38 cents, it bounces. So the first time that was in support level, we had no idea. That was in 2018. And then it hit that level again in 2020, June 2020, and then it bounced. It hit it again in June 2022, and then it bounced. So 3 times it's hit that level, and the last 2 times that was support, and the share price is just above that support level right now at 45 cents after decreasing. And in fact, it's been decreasing over the past few months. So at this point in time, just by looking at this chart, nothing much going on with Veem compared to Laserbond. I probably would be happy or more happy buying Laserbond right now, even though possibly Laserbond share price has fallen through support, because in the long term, Laserbond shares have been in an uptrend since or over the last 5 or 6 years. And that's all I have for this video, looking at 2 small cap companies to buy. Question mark. Question marks there is very important. The whole point of me doing this video is to share ideas with you. If you like either of these companies, now it's up to you to further your research and decide whether either of these companies or maybe both of these companies deserve a position in your portfolio. If you have any questions or further insights to any of these companies, I'd love to hear those. So leave those in the comment section of this video. Otherwise, that's it for this video. Have a good day. The last thing I should mention is I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.